Hey, good morning, everybody, and welcome to this Tuesday, July 29th, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with you again this morning. We do have futures pointing up a little bit today, depending on which index you're looking at. The Dow Jones Industrial Average currently up 0.02%, so not much there. The spider up about 0.2%. So again, it's just that slow, steady crawl, just death by 1,000 needles as far as the bears go. Just continually moving up, not a lot, but seems like we go up every day. So the spider is moving up. QQQ showing a little bit more relative strength, up about 0.4%. And then the small cap IWM up almost 0.6%. So definitely looks like we're pointing to a slightly higher open. Of course, earnings season kicking in. We're getting more and more companies to report. Things will really pick up later this week. We've got Microsoft and Apple and Meta and Amazon all reporting. So all these multi-trillion-dollar companies will be reporting. They're all expected. It was interesting. I think I saw something the other day that said that the Mag 7 stocks were expected to grow their earnings about 14% this quarter, while the rest of the market was expected to grow less than 4%. So it just shows you that strength and the reason why it's so important to follow these Mag 7 stocks. I see a lot of folks that talk about, not wanting to be in the market or whatever because these Mag 7 stocks show such relative strength, and, that they're, just almost like carrying the market to the upside. But if you're invested in the S&P 500 or in the NASDAQ 100, these are market cap weighted indexes. So the large companies are going to carry the most weight. And if they're performing well, you want to be in those indexes. You want to be in the ETFs that track those indexes. That just kind of makes sense to me. But for some reason, some folks say that's a reason not to be in the market, which I don't understand. The better time to be not in the market or not in the spider or the QQQ is when you've got small caps leading, because then you'd rather park your money over in the small caps. But until, we see definitive leadership in other areas of the market, I don't know. I just don't understand the rationale of saying, hey, this market's being led by only the big companies, therefore we should just sit back and not do anything, or we shouldn't trust the rally. I'm thinking, no, you want to jump into this rally. You want to be part of this rally. I don't get it. We've had such a huge run off of those April lows. It just doesn't make sense to me why you wouldn't want to be a part of it. But I don't know. Call me crazy. Anyhow, we do have a Fed meeting starting this morning. The Fed policy statement will be out tomorrow at 2 p.m. So we can expect perhaps some added volatility tomorrow after that, although I'm not sure. I think the market at this point just figures, hey, the Fed's going to get it right at some point, and we're just going to do our own thing until they do. They've been late to the party for so many times over the last 6-7 years that I think a lot of folks just are taking it as just part of the market. The Fed's going to get it wrong until finally they'll get it right at some point. And so that doesn't seem to bother the market as much. The tariffs, which were a big problem, big headwind for the market back earlier in 2025, now seems like it doesn't really matter what happens with tariffs. The market just goes up. So again, I think it's just the market maybe getting a little too comfortable. I don't know. If we have any kind of surprise over the next couple of months, I do think the market is positioned where we could see consolidation for a period of time, maybe even a little bit of selling. We've had such a huge move off the lows. But I don't think, a lot of folks thinking there's going to be a big move down, another bear market coming or something. I just don't see that. None of my signals are pointing to anything like that. So I suspect it's full speed ahead with maybe, a couple of little hiccups along the way. Maybe we lose 3 to 5% here or there, maybe. If you recall, I think it was back in 2017, which was the second year of Trump's first term. We never had a drop of more than 3%. So now that you got a lot of the tariffs out of the way, or at least settling it down, we've seen the market settle down some. I think now that we've gotten to this point, we just haven't really seen much in the way of volatility. The VIX, I think yesterday, let's see, where did we finish yesterday on the VIX? The VIX, we closed at 1503, but we had closed, I think, on Friday of last week at under 1480 or something like that. So it's, it's a market where we've seen a lot of the fear just slowly and slowly and slowly driven out, just drowned out of the market. And now we've just got left this market that just wants to just keep climbing every single day. It seems like it's another couple points here, couple points there. And before you know it, 6,400 looks like we're going to open over 6,400 today. Out of nowhere, we were just at 4,800 in April. So it's just been one of those, we had a huge move off the bottom, but then since then, especially since probably maybe the last month or so, it's just been more of a slow, steady crawl to the upside. And that's really a hallmark of a secular bull market advance, where it seems like nothing takes the market down, fear comes out, and the market just slowly crawls and crawls to the upside. Like I said, death by 1,000 swords, needles, whatever. That's what the market feels like if you're trying to bet against it. All right. Anyhow, let's take a look at what's going on in the market, or what happened yesterday in the market. You can see it was bifurcated action. We did have the Dow down. The Dow's still trying to get through. I think the all-time high close was around 45,014, if I'm not mistaken. Maybe I've got that number wrong, but it's slightly over 45,000. You can see we closed at 44,837 yesterday. So the Dow's up close to a breakout level, not quite getting there. But the S&P 500, just every single day, it crawled up at the end of the day. Well, I shouldn't say it crawled up. It actually spiked up at the end of the day yesterday to eke out another gain. And I think over the last 9 trading sessions, July 18th, I believe, was the day when the S&P dropped like a half of a point, a little over a half of a point. Not a half a percentage point, a half of a point, 1 point, half of 1 point. But other than that, the other 8 days were higher. So we essentially are almost on like a 9-day winning streak, which was barely extended yesterday, with the S&P 500 coming up at the close to finish just slightly positive for the day. NASDAQ up another 70 points. Small caps, mid caps did lag a little bit yesterday. They were up early, then they went back down, went into negative territory. They tried battling back at the end of the day, still fell a little bit short. But this morning, now we got small caps leading a little bit in pre-market. We'll see whether or not that holds up. There you can see the VIX. Actually, the VIX must have closed Friday at 1493 because it was up 0.10 to 1503 yesterday, which was up less than 1%. But again, just it's a far cry from where the VIX was back in April. Remember when we saw it up into the 50s to around 60, showing extreme fear and those huge drops? We didn't know what we were going to wake up to each morning. Well, it's a completely different market environment that we're in right now with the VIX down at 15. Looking at some of the stocks there on the S&P 500, just wanted to mention a couple of them. SMCI, this was the company that had a lot of accounting irregularities and potentially even some fraud involved. I don't like to invest in a stock when it's going through all that process. It seems like it's coming out of it, starting to make some real progress. The stock was up 10% yesterday. I believe that SMCI, and actually, let me pull this one up. SMCI, you can see, got up over 60 yesterday, but it did have the reaction high on big volume back in February, where it closed a little bit above 60. Had one open that was around 62, I think, or 61. Yeah, 61 was the open on February 21st. So a close over that 61 level, I think, would be very bullish for SMCI, and we're right on the cusp of it. Saw the volume yesterday start to pick up on this move. So keep an eye on this one, because if you go back a long time, you'll see this was one of the best stocks in the market. Went through this accounting issue and lost a lot of its value, but it's starting to pick back up again. And I don't know if it moves like it did back in 2023 and early 2024, but it's certainly starting to trend higher. And if we get a breakout, there's a chance that this one goes on a run. So for those of you that are a little bit more aggressive, looking at your stocks in terms of trying to get some short-term gains, SMCI is one. If it makes that breakout, certainly could fit that bill. AMD continues to be very strong. I know this is one of the favorites of Tom Lee's. He's one of the analysts out there that He's been right a lot more than wrong, especially over the last couple of years. But the only thing you got to be careful about with Tom, and I like Tom, I like his approach. He's pretty close to a perma bull. He doesn't really talk too much about pullbacks. Rarely do you see him get bearish or even cautious. He always seems to have a pretty bullish stance. And that would be maybe the only downside to following him. Is, I think you have to show a bearish side once in a while too. You can't always be bullish. So that's one thing I would be maybe a little cautious about with Tom. But otherwise, I mean, he has been calling the market really strongly, really well. And he does like AMD. I know that's one of his favorite stocks right now. And I can't argue the stock's been on fire. Up another 4% yesterday, getting back up above the 170 level. Nike, this is one I've talked about recently. I think Nike may have turned a corner. I'm not going to rule out the possibility that maybe we go back one more time back into the low 70s. But I do think that longer-term downtrend that it had been in for a while has ended. I think we're now trending higher on Nike. But I think best entry would probably be in the low to mid 70s. Arista Networks, I wanted to pull this one up because Arista Networks making a big run, but getting close to a key area of resistance. So back in January of 2025, when the fourth quarter earnings were reported, Arista Networks took a pretty big hit. You can see dropping from a high on January 24th of 133.57 to a low the next day of 97.68. So that was a really big drop. And we fell from a close that prior day of 129.17. And after that drop, we had like a dead cat bounce. We went all the way back up, got to about that 120 and a quarter area and couldn't get through, and then fell back further. Now we've made our way all the way back up, and it seems like we're going up day after day after day, and we are. But I would just be careful about this 120 and a quarter level on Arista Networks. It would be bullish to break above it. I think that would send us up to that 129 gap resistance. But don't be shocked if we hesitate here and don't make it through on the first try. So that would just be one thing to keep in mind on Arista Networks. All right, let's just move on to the sectors. Take a look at what happened here yesterday. Energy leading. Energy has not been a very good area of the market to be in, but it did lead yesterday up 1%. And then, of course, a couple of our old favorites, technology, consumer discretionary. Always love to see when these two areas are leading the market. And I mentioned at the open of the show, when you looked at the major indices, I said they were bifurcated, meaning some up, some down. Look at the sectors. Only 3 sectors were up yesterday. So even though we made a push and we got the S&P 500 into positive territory, it was mostly because of the huge weighting toward technology and consumer discretionary. Technology is 33% of the S&P 500, and I think discretionary is another 10 or 11%. So we're talking about almost half of the S&P 500 are in these two sectors. So seeing those two groups perform well will normally help to lift the major indices. The reason that the major indices weren't up any higher is because the other 8 groups were down, including real estate, materials, utilities, staples, healthcare, all the defensive groups down at the bottom. So we did have a nice recovery yesterday with some of the aggressive areas leading, while the defensive groups did take a back seat. So not bad action, actually. I mean, it's better than the other way around, where the market goes up with defensive leadership or tries to go up with defensive leadership. S&P 500, and this is what I was talking about earlier. I mean, here over the last month, it's just been a death by 1,000 swords. Just every single day, it seems like we're just up a little bit. We're up a little bit. Look at the huge volatility that we had to experience earlier in 2025 with the massive intraday moves. And then look at this. I mean, it's almost like, a gnat compared to an elephant in terms of the volatility, what we're seeing today versus what we saw 3 or 4 months ago. So, the S&P 500, and this is good. This is what you want to see. This is my favorite kind of market. I know a lot of you probably love these, these markets where you just, have this up and down. It's just all over the place, massive moves from day to day. I would rather get into good, solid stocks and just ride them up slowly like this every day, not really worrying about whether I'm going to wake up to a minus 3% futures in the morning, or whether they're going to be up 3.5%, or, I mean, it was just a crapshoot. You'd go to bed. If you're holding overnight, you wouldn't know what you were going to wake up to. Now it seems to be much more steady. In fact, I think it was the S&P 500, or maybe not the S&P 500, but some of the individual stocks within the S&P 500 that have been gapping up almost every single day now for like the last 3 weeks. It just seems like every day you wake up and you've got a slightly higher move in Palantir, or in something like, I don't know, Roblox. These stocks that have just been absolutely driving the market to the upside seem to go up almost every single morning. And really not a whole lot of volatility out there. Now, we do have earnings coming up on some of these companies. Of course, volatility normally is going to pick up as you approach earnings, and especially after you have earnings. And I expect that we're going to see some added volatility tomorrow when we get the Fed announcement at 2:00. But otherwise, it's just been this slow and steady move. And you can see it pretty clearly here in the S&P 500, with only really one attempt in the last month to even go down to the 20-day moving average. I mean, it's just like you gap up and you just kind of sit there all day long. Maybe you gain a little bit more, maybe you lose a little bit, but it's just this slow and steady push to the upside. NASDAQ 100, not much different, just continually moving higher, setting a new all-time high yesterday. Not really much to add on that index. IWM, a little bit more volatility, a little more up and down in the small cap arena, and not as much. We saw some relative strength there for a period of time coming off this 20-day test, probably through about the second week of July. The last 2 weeks, you can see we've been mostly flat in the IWM. And if you look at the last 2 weeks, NASDAQ 100 keeps going up, S&P 500 keeps going up. I mean, my theory on this is, based on what the market is perceiving that the Fed's going to do with interest rates. I think there for a while it looked like we might possibly get a rate cut in July, certainly one in September. And we saw small caps starting to rally as a result of that. And I think over the last couple of weeks, and we've had a couple of Fed officials, by the way, that have talked about, hey, it's time to start cutting rates. So that momentum was starting to build toward rate cuts. And then here recently, we've had some decent economic reports come out that still shows the economy's resilient. We've had other key officials like Fed Chief Powell that still talks about, hey, we need to remain vigilant on inflation, and we still have the tariffs, and we don't really know exactly what's. My point is, I think these last couple of weeks, I think the market is settling back into that narrative that, hey, the Fed's not going to cut rates in July, probably waiting and going to have to wait until September. And so I think some of that move into small caps, I'm not saying it's gone. I just think it's slowed. And as a result, money's rotated a little bit from small caps back over to some of the large caps. But anyhow, you definitely can see the last couple of weeks, it's a little bit more down, sideways action on the IWM, but not breaking down. And I think that's key. We want to watch that rising 20-day moving average. We want to watch recent lows, and we want to make sure that we continue to bounce off of those lows and off of the moving averages. And as long as we continue to do that, I think the IWM is fine. But here in the short term, it'll be interesting to see if the Fed says anything, because I don't think they're going to cut. I think they should cut. I believe they should cut tomorrow. I don't think they're going to. I'm kind of in agreement with the overall market. Very little chance they're going to cut tomorrow. I would love to see a surprise, but I don't think we're going to see one. I think the Fed is going to, I think Powell's going to say what he always says, which is, the economy remains resilient. That buys us the time to see what's going on with the tariffs and inflation, blah, blah, blah. Now, if we see a further weakening economy later in the fourth quarter, or maybe even next year, and we end up having another bear market, which would mark our fifth in 8 years, just remember all of this going on with the Fed right now, because I'm a growing believer that the reason that we've had this unprecedented run of 7 years with 4 cyclical bear markets, let's scratch out pandemic. Nobody could have seen that coming ahead of time. I don't think that had anything to do with Fed policy. But You scratch that to the side, you still had 3 cyclical bear markets in 7 years, and it's all under this Fed's watch. And if they get this wrong, if they hold off and they wait too long to cut rates, and it does eventually impact our economy where we don't rebound strongly enough, quickly enough. Remember, we had a negative GDP report in Q1, and the Q2 GDP report comes out tomorrow morning. Now, hopefully that's going to show a positive number. And actually, that's a good, I have not even looked to see what the consensus estimate is on that. So I'm going to do that while I'm yapping here a little bit. But while I'm waiting for that to come up, I mean, what would happen if we had a second quarter of GDP that was negative? Oh, we're looking for a big number in this next quarter. 2.5%. I'm going to be surprised if we hit 2.5%, but that's what the consensus number is. And the prior was minus 0.5%. So I don't know. Just looking at housing and some of the other areas, I'd be surprised if we hit 2.5%. But that's the consensus. That's what's showing anyway over at Econo Day. So that's what we'll go with. But if the Fed does, like my point is, if the Fed gets this wrong and we end up having a weaker economy down the road, whether it's later this year or next year, and we end up having another big hit in the market, you can thank these policies right now for that. Everybody, well, not everybody, but there are a lot of folks suggesting that, Powell's done a great job. And I completely disagree with that. I think Powell has eventually gotten it right, but the period when he's wrong, I think he has created extreme volatility in the financial markets. And a lot of folks have been hurt by it. A lot of folks have been driven out of the stock market. Folks back in March and April with all the panic over the tariffs and the inflation, the rampant inflation that we were going to get from tariffs, never materialized. But a lot of folks got chased out of the stock market, lost a lot of money in their retirements, now wondering where to get back in. That was all unnecessary. And in my opinion, due completely, or at least in large part, to the Fed. But, if your argument is that, hey, they're trying to manage inflation, that's fine. I would just say, what inflation? Inflation's been coming down now since 2021. It's been steadily dropping for 3-4 years. And so I don't understand that whole argument about inflation. Anyhow, let's keep moving on. Transports continuing to show strength. Went up over 16,500, or actually right up to 16,500 yesterday, which was mirroring the big move that we saw just a couple of weeks ago. I think transports are ready to break out again above 16.5. And this whole move in transports moving up, as I've mentioned on a few occasions, is very, very bullish for the S&P 500. Anytime historically, you can go back and look at history. When the transportation stocks are going up, it only means one thing. It means that they are either improving off a nasty economy, or we're going to have a really strong economy ahead, or maybe just a strengthening economy. But transportation stocks only go up in anticipation of delivering more goods, or just simply, again, rebounding off of a period where shipments were way down. But that's the only reason transports go up. It has to do with shipments and the economy. So if you see transports going up, and I think a lot of this, in my opinion, is based on the fact that we got a lot of folks believing that rates are going to be cut. I think if the Fed continues talking about how, they're going to delay rate cuts, or worse yet, if they start to turn more hawkish for some reason, which I don't put past Powell at this point, if you start hearing more and more hawkish tones, I think this whole rally in transports could fall apart. Now, I don't think that's going to happen, because I don't think there's any reason to grow more hawkish, but just throwing it out there. I think that the reason that transports are moving like this is because the market is anticipating a more dovish Fed environment, not just the rest of this year, but probably over the next couple years. And with lower rates and a resilient economy that could be strengthening, I think transports, that would be a great environment for transports to continue to flourish. So that is my take on what's going on here. I think the market's looking ahead, sees a stronger economy, sees lower interest rates, and that bodes well for shipments. here in the US. 10-year Treasury yield, just kind of, I don't know, in a range right now. Certainly not flying higher in anticipation of higher inflation, but also not, coming down significantly either. So we're just kind of sitting in this range, and kind of a range that we've been in going all the way back to about November of last year. The hope is that the 10-year Treasury yield comes down somewhat, because that'll help mortgage rates. It's a barometer for mortgage rates. So as the 10-year drops, normally you'll see the mortgage rates come back down. I'd like to see the 10-year drop back down below 4% eventually, maybe later this year or next year. I think we will do that. But my bigger hope is that the short-term Fed funds rate drops even faster, creating a widening spread for banks. Widening spread for banks means more net interest margin. If they're doing better and the economy strengthens, that means they lower loan loss reserves. Their interest margin expands. It's very bullish for banks. And when banks are doing well, they lend more. So this whole environment of seeing the spread and the yield curve uninvert further, I think would be a boon for the stock market going forward. I think that's going to be really important to support an advancing market. And I know there's some of you out there that say, no. Last 2 times we uninverted, that caused recessions. Well, the last 2 times that we uninverted weren't because of inflation. If you look back into the 1980s, late 70s, early 80s, when we uninverted, we had one of the biggest bull markets in history. So part of the reason for the yield curve inversion, sometimes it can be due to economics. It can be due to geographical issues. It could be due to inflationary concerns. There's a lot of different reasons. When you only have 4 conversions in the last 55 years or 45 years, it's hard to draw conclusions from 1 or 2 of them. Be really careful not to do that. So I said it back then that you want to be careful. You didn't want to draw that conclusion. And I'm saying it now. Markets at all-time highs. We've uninverted. And we're going to continue to go higher, in my opinion, assuming the Fed doesn't screw things up. Okay, let's see. We got a few more minutes where the market opens. I do want to mention, if anybody hasn't already signed up for this, please sign up for this. We've got an asset class that I believe is in the process of exploding. It's already gone up probably 10% since I started talking about it. I think it's going to go up another 40% by year end. All you have to do is click on that. It'll bring you to this page where you can type in your name, email address, and I will send you a free video explaining the asset class that I think is going to explode. And I'm going to show you the reasons why and the way it's set up like this in the past and how it exploded after the current setup. So no reason not to sign up. Check this out. One more thing we just want to give to our community at Earnings Beats. So please make sure you sign up for that. All right, couple of earnings reports before we wrap up today that I wanted to go over. One was Exelixis. I don't know, I might be butchering the name, but EXEL, this is one of our portfolio stocks taking a hit this morning. They did beat. I did not look at their revenues, but I did see their earnings beat. And I'm looking to see where they came in. Yeah, they were expected to post 65 cents a share in earnings, and they posted 75 cents a share. Now, I don't know if they beat revenues, but if they did, chances are that this sell-off right here at the open may be an opportunity. I wouldn't be surprised to see the stock come rallying back if, in fact, they did beat on both their top and bottom line. Another stock that did beat on their top and bottom line and going the other way is Celestica, CLS. So we're getting about an 8% pop. This one was up as high as about 195 in after-hours trading yesterday. And it's one of the reasons why if I hold a stock into earnings and I get a gap up and the stock's up really nicely, sometimes I'll just take it in after hours, because holding overnight, this stock's now dropped from 194, 195 back down to 186. Still a nice open compared to where we were at yesterday's close. But, the lack of all market makers participating in after hours, sometimes you get exaggerated moves. It can be in both directions. But anyway, CLS was up, like I said yesterday, to about, I think it was up about 12, 13%. Now it's up 7.5%. But still, good day, very strong report for CLS. Those were a couple that came out yesterday after the bell. CDNS was another one. Pretty strong report out of the software company, Cadence Design. And did we open? Yes, we did just open. So Cadence Design, we can just look at the charts now. But it is up 7.5%, $25. And let me give you just a couple more that reported this morning. We got Procter & Gamble, which you can see is relatively flat. United Healthcare came in, missed again by a wide margin, 408 versus 484, another big gap down on UNH. Merck beat 213 versus 201, the stock down anyway. What is that, down about 6% on the session so far? And let's see, Boeing reported this morning. Boeing with a big beat, losing just $1.24 versus $1.54 expected. You can see that stock up 2%. Spotify, I don't know why, but it had a huge miss. Expected $2.13, and they came in with a loss of 48 cents. The stock only down 7%, though, so there must be something in those numbers. Maybe there was a one-time charge that was included in that that loss that was calculated. I don't know. Royal Caribbean came in 438 versus 410. But the stock, a lot of good news priced in, maybe. Trying to maybe make a little rebound off that gap down. UPS missed by 1 penny, 155 versus 156. You can see that one taking a little bit of a hit, down almost 5%. PayPal this morning beat 140 versus 130. Stock still down. And let's see, there was another one. Let's take a look at Corning, GLW. Corning came in above expectations, 60 cents versus 57 cents, stock up more than 6%. Anyhow, let's take a look at the intraday. We'll look at the diamonds, go across the board. Diamonds gapped up, but now flat. The spider gapped up, pulling back a little bit, still up almost 0.2%, putting in a new high versus yesterday. QQQ up over 0.5%, a little higher than its open. And the IWM, again, gapping up and falling back. We've seen that the last 2 days, gap ups and then selling off. So far, we're seeing a little bit of that today, although maybe not quite as concerted as we've seen the last couple of days, but we still have some time to go in this first 10 minutes of trading. Anyhow, overall, pretty decent start to the day. Earnings, like I said, will continue to pick up the rest of this week, the next couple of weeks. But some biggies coming up later this week in terms of the Mag 7 stocks. So definitely keep an eye out for that. Tomorrow, we will get the latest from the Fed. I suspect they're going to keep rates steady. I suspect the Fed's, Powell's going to say the same thing. He's like a broken record. Going to be talking about the possibility of inflation, even though once again, last month, we showed no signs of any pickup in inflation. We'll see what the Fed has to say. Also, we have a non-farm payrolls coming out on Friday, as if we didn't have enough going on this week. Non-farm payrolls. So jobs report coming out on Friday. Anyhow, that's it for me. Everybody have a great rest of your day, and I'll be back tomorrow with members for our live trading session at 10 a.m. See you then. Happy trading, everybody.